Welcome to All Things Policy, a daily podcast supported by Pragati, a flagship media initiative of the Takshashila Institution. We're a bunch of policy nerds based in Bengaluru, and we like to bring a fresh perspective to Indian affairs and an Indian perspective to global affairs. So grab a cup of coffee, sit back, and join us for today's chat.
So, Anupam, would it be accurate to say that banks are giving customers a run for their money, or are they giving customers a run for their money? Okay.
Always start with the joke.
Start with the joke, especially a really bad one. That's what draws people in. Okay, but anyway, welcome to All Things Policy. I'm joined by Anupam Manur. I'm Aditya Ramanathan, and also by Shrikrishna. And we're going to discuss banks, bank runs, what's happening with Silicon Valley Bank, Credit Suisse, and in general with international banking. And we're hoping Anupam can enlighten us. So just to give you a broad background, Silicon Valley Bank earlier this month basically collapsed at one point around March 8th. It said it needed to raise about $2 billion in capital. That led to a run on the bank. Something like $42 billion worth of deposits were removed. The bank was on the verge of collapse. The US federal government came in and bailed it out. After that, we've seen a couple of crypto-oriented banks. We've seen a couple of crypto-oriented banks, Silvergate Capital and Signature Bank also go down. And so this seems almost like it's a systemic crisis, but I'm not sure because we've also seen trouble in Europe, of course, with Credit Suisse. So Anupam, let's begin before we go to Europe. Let's start with Silicon Valley Bank. What on earth happened? Does this represent some major systemic banking crisis, or is it just a crazy bank run?
That's a good question. In fact, that's something that a lot of people are trying to figure out, whether it is systemic in nature or not. Let's think about first that, Silicon Valley Bank is the 16th largest bank. So it's not a small regional bank. It's not Shamrao Vittal Cooperative Society for middle-aged uncles, right? So it's bigger than that. It's the 16th largest bank in the US. And now its collapse is actually the second biggest bank collapse in US history, after, of course, Lehman Brothers. So in that sense, it is big. But yet, what does systemic mean? I think you have to get to, that.
Right.
It's not systemic would mean that they're deeply ingrained into all aspects of the economy. That is, they've lent money to multiple people across the US. Other banks have probably lent to them. They've lent to other banks. They've lent to other big businesses who are dependent on them, or other businesses have their money deposited with these guys. That is what systemic failure would mean, which is that if this bank collapses, then it will trigger a bunch of collapses across the board. I don't think that is the case, because one aspect of Silicon Valley Bank, which prevents that kind of systemic failure, but which is also the cause of its downfall, is that it caters almost to a very narrow niche crowd, which is your tech bros in Silicon Valley, right? That's the name. So you have the entrepreneurs, the startups in California who were largely the customers of Silicon Valley Bank. And now that lack of diversity by itself was a problem, but I'll come to that slightly later on.
So was there something that Silicon Valley Bank did structurally in basically the way it managed risk that put it in this position? Is it just about buying, too many long-term securities with low interest rates? Was that really what triggered it?
Actually, that's exactly it. So if we can blame Silicon Valley Bank for anything in the short run, it is that it did bad risk management, but in the most plain vanilla fashion that you can think of, right? So normally when you have a bank run and a bank crisis, or you have the scandals like Credit Suisse, which we'll talk about later, it's sensational, it's scandalous, it's something else happens. Silicon Valley Bank just bought lots of government treasuries. Okay, that's a big thing they did. If you have to understand the nature and scope of what went wrong, then it is this, okay? Unlike most other bank loans, which doesn't have, basically it's lent too much, etc. Right? That's usually the problem. It doesn't have enough deposits, but it has lent too much in its greedy capacity to get more money, and therefore that kind of asset liability mismatch happens. With Silicon Valley, I think the differentiator is that Silicon Valley had too much deposits. Right? Which by itself is strange, but you have to, of course, now tie this up with what is happening in the, in America, in the American economy, which is again influenced by what is happening in terms of the pandemic. So you had the pandemic, which meant that the US Fed, which until then was slightly raising rates, pandemic hit, they said, okay, we need liquidity, so they massively slashed the interest rates, right, back to around zero territory. Now, when money is that cheap, everybody is awash with liquidity and they're always looking for places to go. So all of the VCs had far too much money. So what they did was they basically, whether the entrepreneurs and whether the startups, etc., were asking for it or not, they basically shoved money down their throats and say, there you go. I mean, go and invest and make me money. So the startups took that money, but of course, it's a pandemic. You can't really make big expansionary plans without knowing what to do with it. There's a lot of uncertainty. So what they did was they took all of their money from VCs and then they kept it with the bank, which happened to be Silicon Valley Bank. Now, Silicon Valley Bank has lots and lots of deposits. They don't know what to do with it. Normally they would make lots of risky bets. Silicon Valley didn't do that. All they did was they said, okay, let's take the safest possible, the US government's treasury bonds, and they invested in that. But the big mistake here structurally is that they invested in 10-year bonds, right? So when you invest in long-term, long maturity bonds, then you're always exposing yourself to interest rate risk.
Right. So, Anupam, the other thing was, like you mentioned, this may not have been the Shamrao Vittalrao Bank for middle-aged uncles, but this was definitely Shamrao Vittalrao Bank for the tech bros, right?
Yeah.
So, the Silicon Valley was deeply invested in this bank in the sense that a lot of the depositors, I think, overwhelming majority of the depositors were from a particular kind of software business in this particular bank. Many of them were also the venture capitalists who operate again in the same space. So when things went out of control, one of the things which happened was people started withdrawing this money. As Aditya mentioned at the beginning, 42 billion was withdrawn on a single day, right? And this kind of bank run was orchestrated and it spread very quickly because of this non-diversified asset customer base that this bank had. And, this makes me wonder as to, first, of course, like how important it is for a bank to have a diversified customer base, and that can actually prevent bank runs in times of crisis like this. And the second thing is the role of, say, social media in exacerbating this crisis, because a lot of these VCs, when actually SVB announced that they're going to sell off some of the bonds to stay liquid, a lot of these VCs came publicly in, say, Twitter and other social media, and they announced that they're going to, take their money back from this bank and start withdrawing their deposit, and which kicked off this bank run. And it's crazy, like in this world of today where social media can be used to bring down a huge bank to its knees, right? And maybe Aditya, you can also pitch in here. Like, do you think like this means now there is some sort of economic warfare that can take place on social media? Is this a part of, information warfare that you look at? So yeah, I want to hear from both of you.
Yeah, no, I'm sure that Twitter was really an important part of this. I mean, I would just place it in the context of how all communications technologies have constantly disrupted finance, right? As soon as that transatlantic cable was laid down in 1868 or whatever, it started disrupting finance. So, I mean, it's really a part of that longer 150-year-old process that we're seeing. And it's just going to get wilder and wilder. And, if you're a bank, you have to learn how to deal with this. I mean, this is something you have to bake into your understanding of risk management in the future.
Yeah, absolutely. So both are extremely interesting points. One, let's deal with it one by one. One is just the diversity and diversification of customers. So if every small investor who's even, investing in small way would know the mantra, right? Don't put all your eggs in one basket.
Precisely.
So if that happens for investors, even for banks, I mean, in a way, their customers are their, one single basket. So you shouldn't have the similar kind of eggs in that basket, right? Because the chances of something like this happening, contagion, will always be higher. Which is true for any other bank. So if you have a bank which is solely exposed to one industry, I mean, it could be, for example, Shriram Finance for transport. Yeah. It has the same problem. Right? If the transport sector goes down, let's say thanks to the pandemic or something, the chances of, this is not investment advice to anybody, right? But the chance of a particular bank which is overexposed to one particular sector will always be higher, right? And that can cause this thing. But the second aspect, I think, as you say, is that not just that the customers were of a similar type and therefore were exposed to the risk to that particular industry, but it was also the same kind of customers who would hang out on Twitter, who would talk to each other on Twitter, who would follow each other on Twitter, etc. So when the VCs who had funded some of these things publicly said, Peter Thiel, for example, publicly said that I've withdrawn my money and, I would recommend all of you to do the same. Yeah. Of course, it's going to result in a bank run. So I think those are important aspects and it begs the question of, can you now orchestrate a bank run? Right? We don't have to get into that territory because it's speculative, but this should be studied in this context, right? Whether you can, create panic and so on through social media. It's happening in other places. I mean, there is panic created and moral panic created for other aspects. Again, we need not get into that necessarily now, but if that goes on to the realm of finance, which is already extremely vulnerable to panics and hive mind and mob mentality and all of those things.
Mood and sentiment, essentially.
Yeah, sentiments, animal spirits, you call it what you want. But given that it's especially vulnerable to all of these, possibly there's further damage down the road that can be done. So it's worth looking into and thinking of. And that also explains why the Fed kind of moved in as early as it did. It just seized assets. It didn't allow time for SVB to kind of figure out what to do. I mean, in fact, the trigger for all of this was just SVB being super honest.
Yes.
Okay. I'm not.
So they were penalized for being transparent.
Yeah, because they just said, we have an asset liability mismatch in terms of liquidity, not even in terms of this thing. We have an asset liability mismatch. So we are selling some of our bonds that we hold at a loss, right? And so that we get liquidity. And that just created panic. That just created a lot of panic, and people were like, oh, if they're selling at a loss, then it means that they might be in trouble. And then, of course, that's what it got amplified on Twitter. Yeah. So for those of you, for those of you who are interested, SVB had bought long-term bonds, 10-year maturities. So it means that their money was fixed for a long period of time at a low interest rate, right? Now, without getting into the technicalities, you have to know that when the Fed raised interest rates, it meant that the bonds that they held were worth less. The price of the bonds that they held went down. And so therefore, everybody started questioning what is the current value of, SVB and how much they held. And that created the panic.
Yeah. So, it's actually, I am myself curious to, speculate about whether this was actually an orchestrated sort of bank run or whether it was just stupidity. But I suppose it's useless to speculate that. But what I'd like to hear from you, Anupam, before we move on to the rest of what's happening with banks, is how much of this is a regulatory oversight? How much of this is the failings of US regulators?
Yeah. So I think that's a fascinating question. Essentially, what is often ignored or even used interchangeably is this idea of regulation versus supervision, right? That you need to supervise. Now, these two things are often used interchangeably. They say this was a supervisory failure, but then they talk about regulation. They talk about regulatory failure, and then they talk about supervision. But I think it's important to just kind of isolate these two terms, understand what they mean, and see what are the failures. Now, SVB has both components of it, but important to kind of look at what part of it was a regulatory failure, what part of it was a supervisory failure. Therefore, you'll know how to kind of fix it, right? Now, let's start with the basic question. What is the difference between the two? Regulation is about creating rules, as you would know, right? So you have a set of rules that you create on how to do banking. What are the things like capital adequacy ratio, how much deposits you need before you can lend, how much can you lend, where can you lend, where can you invest that money? These are all rules, right? Now, supervision is about enforcing those rules, whether the rules that you have are actually, are being followed or not. Now, with SVB, you see both of these things playing out. Okay, so the first thing, I apologize in advance if I'm getting into too much detail, but the first thing I think you have to learn about is this thing called the Dodd-Frank Act. Okay, with the legendary Dodd-Frank Act, which basically has, and the Dodd-Frank actually, you'd find this mentioned everywhere, but it's a set of 17 different laws. Okay, it's about 17 different laws on how banks should operate. Okay, so it's called Title 1 or up till Title 17. And it has all of these rules on, what banks should do and how should they behave and all about those bits. Now, the first thing that you have to know is that initially the Dodd-Frank Act said that there will be massive amounts of scrutiny for any bank worth above $50 billion, right? So if they have deposits and assets above $50 billion, then they will come under scrutiny, immense kind of scrutiny, and they'll have stress tests. There'll be, open-ended discretionary powers that the Fed can use in testing the waters on how good or bad these things are and whether they're open to, whether they're vulnerable, etc., right? So all of that things. Now, this is a regulatory failure. So you had this mechanism in place, but during the Trump era, this limit was raised from $50 billion to $250 billion. So now, if that hadn't happened, then SVB would have had to be regularly monitored, scrutinized, etc. But now, because it went from 50 to 250 and SVB was below that kind of threshold, it no longer was under that scrutiny, right?
Right.
So We can blame Trump even for this.
Absolutely. How much of a role did that, that the fact that SVB did not have to basically mark to market, right? They didn't have to revalue their assets, when bond prices went down. Was that a big part of this?
That was a big part of it. So if you had very strict supervision, these things, you'd have to, submit a report, you'd have to submit audit things, all of those things which I think were skipped, right? So because they were no longer obligated to do that. The second part is, you also had a part of that Dodd-Frank Act where every bank had to, I'm just saying this because I found it really interesting, but every bank had to write something called a living will, okay? Which is that if we go under, this is how you can recover part of my assets and then spread it to all the depositors. Okay. And so therefore, it did not require the intervention of the FDIC or any other kind of external injections of liquidity. You were supposed to take care of all the liquidity requirements. And that was a living will. Now, again, that was no longer a requirement. So that's a regulatory failure. Just moving it from 50 to 250 and therefore letting a lot of these banks go under. Right now, there was supervisory red flags as well, which I think the Fed did not see. But I'll be a lot more brief about this. But, you had explosive asset growth in SVB quadrupled its assets in 4 years. That by itself should tell you, there's a lot of assets. What are they doing with it, right? Yeah. So that should have triggered some red flags and some cautionary tales for this thing. Then a lot of that was uninsured deposits. Now, in the US, deposits up to 250
million.
1,000?
1,000, right.
250,000 comes under the FDIC's limit. Anything above that is not insured, right? 97% of SVB's thing was about $250,000, which meant that it was not insured. So if you have 90% of your assets not insured, that obviously creates a lot of trouble. Then the other bits which we know, they were exposed to interest rate because they invested so much in securities. That was another supervisory failure and so on. So I think these 2 or 3 things should have raised red flags, which it didn't. So it's a combination of both regulatory and supervisory, but good to probably just kind of break it down as to which is which.
Okay, so Anupam, now let's skip across the continents and go to Europe, where another bank crisis is playing out, which pertains to Credit Suisse. And of course, unlike SVB, Credit Suisse is not the cleanest bank. It has a very tarnished history. But today it is being bought out by UBS because of something similar which went on. So would you elaborate on this crisis happening with Credit Suisse?
Credit Suisse, I think, is a lot more simpler case to explain. And I mean that only jokingly. It's very simple because, the explanation for why Credit Suisse is going down is very simple, right? It's karma. Because they refuse to take Adani shares as collateral, this is karma. Okay, ask anybody on Twitter, they'll say the same thing. Okay, now jokes apart. With Credit Suisse, I'm amazed that it has survived as a bank for this long. It is truly amazing and probably tells you about the regulatory mechanism in Europe and how broken that is. Much more than anything else can. Because Credit Suisse should not be operating. Given the amount of scandals and the amount of, almost sensational breakdowns that has happened, by now it should not have been a bank, right? But it's okay. So the trigger for Credit Suisse is nothing but, it's investor confidence. So lack of investor confidence. And so there were other banks, both in the US and in Europe, which suddenly started facing the pressure because, once you have a bank failure, and this is where that question about whether something is systemic or not becomes moot, because now people are saying, everything is systemic. Right? Irrespective of your size, because if you have one bank going down and that can massively reduce investor confidence and they start, let's say, withdrawing their deposits or even start selling the shares of that particular company, that can cause a systemic failure. Right? So even though it is not connected in the way that I had mentioned earlier, just the lack of investor confidence or the dip in investor confidence can cause a systemic failure. Right? And Credit Suisse was clearly one of the victims, if I could mention, of this dip in investor confidence. So now, if you want to go back to the historical aspect of Credit Suisse, which I'm sure will be entertaining, let me just mention probably 3 or 4 that I remember, and there's actually lots more, right? Okay, in 2019, you had the CEO of Credit Suisse, which was Pierre-Olivier Bouyer. So he was discovered to have private investigators to spy on high-level employees. Okay, so I mean, he was spying on his own employees by using private investigators. That broke out. It became a big scandal, and he was fired shortly after. Right now, the private investigator also took his own life, and I'm doing air quotes here. But the bank announced that the private investigator also took his shady, right? Really, really shady. But apart from that, there was also, there's quite a few scandals about money laundering, about siphoning of funds. And then there were two big investments they made, which made no economic sense, which again begs the question whether there was corruption.
Right.
One was this place called Archegos, I think, Archegos Capital Management. So this was like a family office, which suddenly imploded in 2021, and lo and behold, you find Credit Suisse has got unnaturally large kind of exposure to this, right? A month before the Archegos scandal went public, you also had something called the Greensill Capital, I think. So Greensill, again, in March 2021, they declared insolvency. You then find out that Credit Suisse had huge kind of exposure to it. In Feb 2022, you figured out that there's a massive leak of of Credit Suisse employees, of Credit Suisse clients and so on. $100 billion in wealth that was financed by Credit Suisse was done to people who had profited from torture, drug trafficking, money laundering, corruption, and all other sorts of serious crimes. So you see, there's a pattern here, okay? There's clearly a pattern. Top leadership has been changed multiple times just since 2019. I think the recent one came in about July 2022, where they got a new CEO, etc. So I think there's just the bank is mired in controversy, which only goes to show that at the first kind of fall of the chip, obviously this is the bank that's going to get affected in terms of people losing confidence in it because of its history of really bad decisions.
Yeah, I'm amazed by Credit Suisse. Let me put it like this. Even if you have no interest in banking, Credit Suisse just seems really interesting. So, besides, Greensill and Archegos Capital and all those guys, there's all sorts of other deals. There's one involving amphibious warfare boats for Mozambique. There was also a time when I think the CEO and the deputy bought lakefront property in Zurich, and then their partners started squabbling, and then they both had to eventually exit. So, great stuff. But Anupam, what do you think of this essentially bailout of Credit Suisse, and what does it say? Again, does all of this just create a lot more moral hazard? And also, what does it mean anything systemic for European banks?
Yeah, now I'm going to sound like a typical economics parrot, which is to say, I have to shout out moral hazard at the top of my voice. Both what the FDIC and the Federal Reserve did. Let's start with that, right? So firstly, the Federal Reserve said that actually the Biden administration, not Federal Reserve, the Biden administration said that, even though you have insurance cover only up till $250,000, they made an announcement that every single depositor, irrespective of how much you had, so even about $250,000, would be made whole, which is that all of your deposits should be returned. Now they made some complicated promise about how they will not take this from taxpayers, but instead they will actually use the long duration funds from Credit Suisse, from SVB, and then use it for repaying this thing. It doesn't matter, right? That was the first strike of moral hazard. Now, going forward, what would be the incentives for banks to be more careful? What would be the incentives of depositors to be more careful? I don't know about you folks. Aditya, you're an extremely rich man with like millions of rupees. Yeah. Do you put it all in one bank, or do you spread it across?
Even with my very meager assets, I spread it across two banks.
You spread it across two banks, right? 5 rupees here and 10 rupees there.
That's right.
So
and in India, I think the insurance is only up to 5 lakhs. 5 lakhs. So you better spread it.
Yeah, you better spread it. You need, Aditya needs about, I think, 45 different banks. Sure. So, but that's the idea, right? Now, you're creating a moral hazard where, again, for those of us who might not be aware of that term, moral hazard is where the consequences of your action are not borne by you, but are borne by somebody else. And in cases such as that, you would tend to take a lot more riskier bets, right? If I can do something and get away and not face the consequences, I will do risky stuff. So that's the idea. And so the first kind of thing is the $250,000 limit. And then even Signature Bank, etc., they took over, they did a whole bunch of things and they sold it. So now I don't know. Will depositors be... You can weigh the moral hazard against the systemic argument, right? You can say, I'm okay with the moral hazard as long as I don't create systemic risk, especially at a time when, you're just kind of recovering from the pandemic and so on. But, well, as a microeconomist, I would have to keep shouting. Same thing with, the Swiss National Bank, Swiss Central Bank bailing out Credit Suisse was just extraordinarily stupid, especially Credit Suisse. So this is not, there's a history of failure here. There's a history of this thing. They should have been clamping down on Credit Suisse a long term back, or making sure there's extra deposits. Now, who are the people who still kept money with Credit Suisse? I really want to meet these guys, right? And so
you won't know their identities.
Yeah, we won't know their identities. Now, the other aspect which will really hurt the externality is to the brand image of Switzerland. You think, the greatest, supposedly the unique selling point of Switzerland is that they can offer safe and secret banking. Now, secret will remain, but the safe aspect is in question. So now, will people still go to Switzerland and keep money? We have to see. This will dent their confidence for sure. And apart from, of course, as you said, the moral hazard stays true.
Good.
Yeah, other than what you mentioned, when the central bank or the government steps in to bail out these failing banks, another model which has come to the fore in recent times is when, by the concerted actions of the central bank and the government, they essentially get some banking peers of this particular failing bank to buy them out. Like this happened in the case of Yes Bank in India, when I think SBI and few other banks bought out Control and essentially bailed out Yes Bank. And similarly, I think with the bank called First Republic in US, something similar is happening, where I think JP Morgan, Citigroup, Wells Fargo and few others have come in, and they're essentially taking over this bank. And I would believe that this is being done with some sort of nudging by the central bank, and not out of pure volitions, if I may say so.
Way more than a nudge, but yes.
Yeah. So what do you think of this kind of model of a bank rescue?
It's an easy way out for the central bank, in the sense that now they can kind of keep their hands clean. They can say that, we're not using public money to do this and so on. But in a way, of course, there are multiple problems here, right? One, you're distributing the bad assets again to the newer banking entities. And if there is a situation where these banks are already considered too big to fail, you're only increasing the concentration of market power, right? Which can have disastrous effects down the line. And then, of course, the lack of agency, lack of economic freedom. You're arm twisting banks to make decisions which they otherwise wouldn't have. Now, in India, of course, it's done through public sector banks and so on, which already are, have very little freedom and this thing, right? They're forced to lend places where they don't want to lend. They're forced to take deposits where they don't want to, and all sorts of things, funny things happen. So this is an extension of that, where you further take away the autonomy and independence and agency of the public sector banks.
Yeah, clearly UBS was not happy with this shotgun marriage, but I assume that the Swiss government nudged them to do this, actually to maybe try and protect the image of Switzerland as the safe banking destination. But, speaking of safe banking destinations, I want to get back to this question, Anupam, of whether this is really, why this is more widespread. Shri talked about First Republic, this Signature Bank, again, which, used to lend to real estate companies and so on. These aren't necessarily some Ponzi schemes, right? These are like fairly well-established banks. Why are they failing?
There's a structural reason here, and that is just interest rates, in my opinion. So you had a large period of easy money. All the way from 2008 onwards. So when you had the banking and financial crisis of 2008, and then of course the economy went through a tailspin, and so therefore the Federal Reserve had to lower interest rates and ECB had to lower interest rates. So there was lots of liquidity, and so interest rates were low for a very long time, right? So in 2013, for example, they started saying we'll stop doing quantitative easing. They didn't raise rates; they just said we'll stop doing quantitative easing, right? And again, that resulted in what you would call as taper tantrum. Again, in 2015, 2016, they did taper tantrum part 2 and so on, right? So they didn't actually start increasing interest rates until 2018 or so, which is when they started. And then 2020, the pandemic hit. So which meant that they again had to reduce interest rates. Now, when you have interest rates extremely low, it means money is very cheap, right? So, and with cheap money comes speculative bets and speculative investments that people take. So you have a lot of money. VCs, as I said, VCs have money, and so they give to startups. Other people had money and they put it in crypto. Then other people invest in real estate, etc. That's how bubbles are created. By the way, the 2008 bubble financial crisis, by the way, was a direct result of the US Federal Reserve keeping interest rates for a long period of time at 1%.
Yeah.
Right. So what we're seeing now is a repeat of that. but across the board. It's not just real estate, but it's kind of diffused. But the crypto falling, for what many people may or may not realize, is a direct result of just raising interest rates. When money becomes more expensive, people start saying, okay, can I really put it on such risky things, right? People go, which is why you also have, investors withdrawing from emerging markets and going to the safe haven, which is the US Treasury bond, right? So this happens. People go withdraw money from riskier bets and put it in safer things when interest rates rise. And that's what happened with crypto. That's what will happen with real estate. So if there are certain banks which are overexposed to some of these risks, like your signature bank and crypto, you will face the consequences. So when suddenly money becomes expensive, the bets, the cost benefit analysis of those bets or the probability of returns will suddenly change, and now confidence will also go down. And so therefore when crypto falls, then the bank falls. When real estate prices go down, other banks will fall. So that's the kind of, I don't want to use the contagion, but I think this is just the direct result of kind of raising interest rates. Now, having said that, can you blame the Federal Reserve for raising interest rates? Absolutely not. That's their job. That's the mandate that the US Congress has given. I see a lot of really negative kind of commentary about Federal Reserve raising interest rates. No, right? If you look at the mandate of the Federal Reserve, it is to, of course, maintain price stability. The other aspect is unemployment. In India, that's not even the case. In India, RBI's now sole mandate is price stability.
Yeah.
Right? So, in the US, it's dual mandate, what you would call as a dual mandate system. It's both to ensure price stability or control inflation in layman terms and ensure employment, right? But you have the situation where Federal Reserve raising interest rates, everybody is now getting spooked and saying they're raising rates too fast. No, not enough. In fact, inflation just came about and it's at 6% in the US. You have persistently high inflation in the US, and their job is to control inflation. So this is not a fault of Federal Reserve. It's a fault of people who didn't understand that once rates come down, they will also have to go up. How stupid do you have to be if you didn't kind of factor in interest rate risk? Then you don't deserve to be a bank. You don't deserve to be an investment house. You don't deserve to be investing. Forget everybody else's money. You don't deserve to be investing your own money. Or you deserve the losses.
And you shouldn't be bailed out.
Yeah. You shouldn't be bailed out.
Yeah. So the Fed is in kind of a fix here, right? So they have to raise interest rates. That's going to bring costs with it, like in the early 80s. Or they cut rates again, and that's going to create all sorts of fresh problems, right? So what do?
I wouldn't know. If I knew that, I would be at the Fed.
Okay.
But it's difficult. Now the Fed, they can stick to their guns like Paul Volcker did and say, our job is price stability and I don't care what happens. I'm going to keep raising interest rates. But again, in the age of social media where you come under such direct attack, and now even the political and monetary kind of boundary has slightly diluted. So Jay Powell has to keep, testifying before Congress, etc. It's a little bit more difficult as to what they do. At best, they can hold off raising rates further. I don't think they'll decrease it. That's not even an option on the table. If in the next monetary committee meeting that they have, if they keep rates, then political pressure is working, because if not, they were supposed to raise it.
Yeah. So coming to India, actually, as you mentioned, RBI, the mandate after the monetary policy framework is to control inflation or ensure price stability in the economy, right? And the RBI has also been consistently raising the repo rates for the last year or so, I think more than a year now. And it has increased by 250 basis points. And in the forthcoming meeting in April, it is expected that the rates will go up again. So applying this sort of theory of interest rate rise and bank collapses that we spoke about at length today, where do you think Indian banks stand? Because I'm sure in India, the financial repression is more, because a lot of banks are forced to hold government securities, which are subject to both interest rate and duration risks. So are Indian banks also sitting on huge unrealized losses, much like SVB did at one point in time? Or do you think our banking sector is more robust and we are better off? So what's sort of your assessment?
I wouldn't say robust, but yes, Indian banks generally, I'm very scared to say something now and then later something else will happen. But the good news is nobody listens or remembers what I say. So Indian banks are regulated a lot more sternly than their US counterparts. The fact that you need a cash reserve ratio of something like 4 to 5% of your deposits, and SLR, which is statutory liquidity ratio of up to 20% odd. And then there's all sorts of things of where do you lend and so on. So I think they're regulated far more sternly. So I don't think interest rate risk in this manner is going to play out in the Indian banking sector. What you will have, I think, is in a way their share prices will fall because, again, it's just confidence. Like it's happening in Europe as well. BNP Paribas, for example, doesn't have many of the risks that we spoke about, but it's struggling because people are scared. They're spooked, so they'll sell off shares. So Indian banking stocks, again, not an investment advice, but Indian banking stocks are taking a hit and will probably continue to take a hit in some time. But I don't think their fundamental core businesses will be affected too much by this. So you'll have sell-off of banking stocks. You'll have some bit of investor confidence. FIIs are withdrawing. So FIIs will withdraw money and go away from the Indian stock market, which, by the way, that will result in probably a rupee depreciation slightly further. So I think these are some of the effects that you can see on India, but hopefully, so it depends. At what point will this turn into a global kind of contagion? Then you can't can't stand away. In fact, compared to 2008, I would say we're a lot more integrated into the global economy now, which is a very good thing generally. But in times of crisis, it'll only mean that we probably get slightly more affected than we were in 2008. But Indian banks per se are not integrated because we have capital account convertibility issues and so on. Indian banks are not necessarily very closely tied with their global counterparts. So in that sense, it's not a risk. But stock markets will probably take a hit. So that's what you need to look out for.
And finally, India's tech sector, any risks?
Yeah, Indian tech sector will definitely. VC money is going to dry up as it is. Interest rates were going up, which means there was a liquidity crunch. Now, given that banks are failing and so on, there will be a further liquidity crunch. There's also investors are spooked. And so therefore, probably, again, not an investment advice, but gold prices will start rising because everybody will go to safe assets, right? So the dollar and gold, these are the things that they'll go into, which means slightly more riskier bets such as funding startups or funding other tech companies, etc. You might see slight withdrawal there, or at least no massive increases.
Yeah. Like, I think even the Bitcoin prices are rising because my generation thinks that Bitcoin and gold are the same. So.
Wonderful. Yeah. So anyway, on that note, thanks Anupam for helping us put together such a cheerful episode of All Things Policy on such a gloomy subject. And hopefully we won't have to do a sequel on further banking crisis.
Yeah. Hopefully this is a one-off. Thanks.
Right. Thank you.
Thanks.
If you liked our show, don't forget to check out other interesting podcasts on the IVM network. You can tune into them on the IVM Podcast app, ivmpodcast.com, or wherever you listen to your podcasts. You can also follow IVM on social media. The handle is @IVM Podcasts on Twitter, Facebook, and Instagram. And hey, if you'd like to dive into Takshashila's research on technology, strategy, and economic affairs, check us out at our Twitter handle @TakshashilaINST or our website takshashila.org.in.